Hello and welcome to today's webinar, Common Startup Mistakes, presented by Early Growth Financial Services. My name is Patty Montoya and I'll be your moderator today from the Early Growth Financial Services team. I have a few quick notes before we get started. The webinar will last about an hour and that includes time at the end for questions. So feel free to type your questions into the control panel and we will answer them in between slides. The next thing to note is that this webinar will be recorded and sent to all the registrants with the slide deck within 48 hours. You can also find this recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speakers today, I would like to tell you a bit about Early Growth Financial Services. Here's a quick description of what we do. We are an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. Now, without further ado, I'd like to introduce our panelists, Alaa Ismail and Sirk Roh, who will tell us a bit about themselves and kick off today's discussion.
Hello, everyone. My name is Alaa Ismail. I am a consulting CFO here at Early Growth. I've worked with many interesting startup companies here in the San Francisco Bay Area, as well as in some other areas of the country like New York and Chicago. My primary area of concentration is technology, but I've also worked with e-commerce companies, manufacturing companies, and other service type companies that are in their formative stages. And I'm happy to be here.
Hi everyone, my name is Sirk Roh and I am also a consulting CFO with Early Growth Financial Services. I've been with the company for about 5 years and like Alaa, I've been working primarily with early stage companies, both in the tech space as well as in other industries as well. And prior to that, I worked as different levels of financial controller, VP of finance, CFO, at other early stage tech companies here in the Bay Area. Thank you all very much for taking time today to listen to this presentation. We obviously are very excited for anyone who ventures out into the startup space, starting your own company, and we commend you on your efforts and wish you the best of luck, and obviously anything that we can do to assist you in avoiding any early stage startup mistakes. That's kind of what we're here about today.
Thanks, Sirk, and I'll just kind of give a brief overview, and the slide kind of shows an outline of what we'll be diving into in a little bit more depth. We'll talk a little bit about some of the areas where we've seen that companies have really not prepared themselves very well. The primary items related to fundraising, I think that's a very important area, and area that is something that if we could avoid mistakes, we could increase our chances of raising funds. We'll be talking about various financial issues. At the early stages of the company, infrastructure and support are always a key, so we'll talk a little bit about that. We'll definitely get into hiring. A lot of times when you're starting up, maybe it might be your first venture into running a business. So we'll talk a little bit about hiring mistakes from an employee side and from consultants. Just general areas of concern that you might encounter. Then we'll kind of wrap it up. And although we'll have a Q&A session at the end of the presentation, as Patty mentioned prior, please feel free to include your questions, and to the extent that they're applicable, we'll cover them in between slides. So with that said, we'll go over to our first slide. Sirk?
Great. Thanks, Ala. So this is the lack of preparation. And actually, even before we get started, Patty, if you could go ahead to the next slide. Before we get started, we just wanted to address one thing, which is that, here at Early Growth, especially being based in the Bay Area, but with offices kind of around the country, one of our, primary industries that we assist in is with tech startups. And so a lot of our presentations, including this one, will have a fair amount of material that kind of covers, tech startups, meaning venture-backed, outside investors, and so on and so forth. And so we'll be talking about that. But obviously, many of the concepts that we're going to be discussing today will go across different industries. You may be starting a mom and pop shop, or you may be starting a small company where you're not going to be necessarily going after outside investors, but being able to build your company internally through revenue. And so a lot of the same concepts apply, but obviously, and each company and each industry will have their own particular things that are going to be critical to their success. So just kind of keep that in mind. But as we kind of talk about when we first get started, obviously preparation is key. It's probably an industry that you have some familiarity with, that you're starting out in. Maybe you have some personal experience. Maybe you have an interest in a particular product or service idea, or a specific expertise that allows you to get going in this space. But even with all that, obviously being prepared for kind of what, the entire life cycle of starting a company and running it to success is critical. And so, these are some of the things that we want, to start thinking about, immediately. I'm going to jump around a little bit here, but in terms of, initially when you're first starting out, putting together a business plan that looks at, basically everything, right, about the market. About how we're going to penetrate that market and be successful. What kind of financing do we need? Are we going to be able to grow this thing from our own personal funds and friends and family, or are we going to be, do we have the kind of company that will be able to attract outside investors, and do we really want to go in that direction? Thinking about those kinds of things. Obviously, putting together, as you're doing that business planning, putting together a forecast of your finances and expenses, what kind of hiring you're going to need, putting together a business plan in addition to a financial plan is obviously something that we need to do, so that we can understand kind of, what the risks are and really what resources we're going to need. The second bullet point here, the legal formation and founders equity grants, this is really, really critical, right? So there's different types of business formations that you can do. You can have a sole proprietorship. You can have a partnership. You can set up a flow through corporation like an S corp or a limited liability corporation, or you can do a C corp. Which is kind of the most complicated type of legal formation, but many companies need to set up that way. And so obviously, if all this stuff is kind of new to you, then one of the things you're going to really, really want to do is understand what some of these differences are. And to that point, I'll skip to the fourth bullet point, which is selecting business partners. And the first thing that you're going to want to do is obviously, talk with lawyers who are going to be able to assist you, not only in setting up your company, not only in determining the right formation of your company, but also in making sure that you're setting up, your company properly, and also protecting yourself from any, potential legal issues that you may have. And this is one where, I would say that, it's, we know that lawyers are expensive. And obviously we're trying to do everything that we can initially to curb our expenses. But understanding kind of the space that you're in and working with lawyers who are knowledgeable and experienced in both the type of company that you're trying to set up, as well as the industry that you're in, is really, really critical, right? I mean, I can tell you that you can't just look at hourly rates. Good lawyers already have a lot of built-in documentation that can be used to help cut expenses. But this is one where you just don't really want to you don't want to cut corners here. You really want to make sure that the lawyer you choose is going to be helpful to you initially as well as going forward. And obviously other partners as well. You may or may not want to use an accounting outsource services from like Early Growth. You may not need that initially. You're going to want to make sure that you choose a bank, right? And you're going to want to choose insurance service providers or insurance brokers who can help you select the right insurance for your company. HR providers, payroll service providers, all of these business partners that are going to help you get started, as well as help you be successful going forward. You need to think through those issues really, really carefully. And then obviously for our tech friends here, the last bullet point on IP, intellectual property, and making sure that you understand what it takes to protect any intellectual property that you are developing, so that others can't infringe upon what you guys are doing. That is obviously critical. And again, really, I stress that you want to work with intellectual property attorneys who are going to be able to help you protect your IP properly.
Okay, so the next vital area, once you've done the planning that Sirk just mentioned, I think that I can't understate the planning stage is super critical, as Sirk just outlined. So typically the next stage is fundraising of some kind. We talk a lot about the technology and the VC-backed companies, and we'll get into the details of that. But I want to also stress that, again, there's a lot of companies that are formed out there without any fundraising. But in lieu of that, if you're not going to be raising money, if you're going to be bootstrapping it, getting an idea of the amount of money needed to get your enterprise off the ground is still very valuable. Whether you're going to a bank, a VC, or an uncle or a related party, it's still a very vital exercise that you plan your fundraising and you plan the funding of your enterprise properly. So regardless of who you're going to, these points I think are valid, whether you're going to a VC, angel investor, or bank, crowdfunding, or a related party of some kind. The first thing that typically comes up if you're going to go out and raise some money is, okay, what's the value of my enterprise? Here, it's typically a good idea to get some outside help, whether it's an investment banker, a VC, or somebody that is knowledgeable of your industry, and especially the stage that your business is in. Different businesses have different valuation strategies. It could be a revenue multiple. It could be just simply a comparison to other companies in similar markets. Or frankly, very early on, it could be just a number that investors agree on. We find that in very early stages, especially in here in Silicon Valley, the primary funding vehicle for early stages is convertible debt. And one of the key reasons why that is that in very early stages, it's difficult to get that valuation, and convertible debt is a convenient way to get companies funded while not really focusing on what the proper valuation is until the company has a little bit of traction, and then the valuation issue could then be outlined a little bit more with key players, especially through potential investors. What I find in the valuation discussion early on is like any other kind of item that you're trying to value, whether you're trying to sell your house or your car, market conditions usually prevail, or a negotiation will happen. If you're going out to raise money from a VC, for example, the VC will have an idea of what similar companies in your stage are being valued at. And then there's a give and take. Getting the proper valuation is key. Undervaluing your company early on could be a big mistake, but in some cases, overvaluation, if you have an exuberant investor who will come in and thinks very, very highly of your company and value it at a way above market price, that could lead to a down round at a later stage. So significant overvaluation, and I stress significant overvaluation, could also be an issue. Figuring out your funding structure. I talked a little bit about convertible debt. Convertible debt may delay until the valuation discussion, until you have a little bit more momentum in your enterprise. That might be the proper funding structure for you right away. It could be that if you already have revenue and you're already profitable, you may want to avoid VCs or outside investors and go directly to bank debt. If you have a product and maybe you're not getting a lot of traction in the investment world, maybe crowdfunding is a way to get your enterprise off the ground. So figuring out early on what the best funding structure is. It could also be a friends and family type round where you just want to get some validation of your idea. And maybe the best way is to go to friends and family and get some funding. But figuring out that funding structure is very, very critical, and could take a lot of your planning time. So determining the proper direction is really key. Then the next step is finding out your funding objectives. I find that a lot of companies or enterprises, when they're starting, they kind of look at funding as the end all of their goals. And what I stress to a lot of my new enterprises is raising $10 million or $30 million does not necessarily indicate that you're a successful enterprise. Your raise is kind of a vehicle to get to success, but it's not the end of the story. So find out what your funding objectives are. And also, the best approach with that objective is to do it in stages, because enterprises have a life of their own. You're going to have ups and downs. So figure out key milestones in your business plan and plan the funding around those key milestones. Because as your enterprise progresses, whether it's developing a product, once that product is developed, then your valuation will significantly go up. So you don't want to undervalue at your company at a very early stage. Once you start getting revenue, your value will change. So having a tiered approach to funding objectives is something that I always push. Once you've figured out which way that you want to go in the funding, then negotiate the terms. Here, if you don't have any experience, I really stress that folks should get help. Get somebody else who has negotiated whatever kind of funding that you're doing. If you're doing a convertible note, either hire a lawyer or talk to a lawyer that has negotiated the terms, so what kind of discount rate you're given, what kind of interest rates are out there, and what are the terms. If you're doing VC type investment, get some help on your side so you're not giving away the store in negotiating the venture capital investment. And if you're talking to a bank, talk to more than one bank. Get them to compete. Negotiate the terms. Don't think that the that you have to take whatever the funder is or the prospective investor is giving you. You have a great value, and hopefully you could negotiate that in your fundraising. And finally, really think about who your investor is. When we talk about investor management, just because somebody is willing to give you money, that doesn't mean that that vehicle is the best investment investor that you could have. You know, I talk to companies that are looking at VCs, and I say, okay, which are going to add value to your enterprise? You know, not every VC is the same, not every angel investor is the same, and if you're going to a bank, not every bank is the same. So if you're going through bank lending, there might be smaller, more agile banks that will help you and be a lot more service than and understand your situation better than a big bank. If you're going to VCs, there are VCs that specialize in certain industries that may have connections that will help you get to revenue faster, or will help you hire key players in your management. So, you know, getting money is not just a one-way street where you're going out and, you know, asking folks to invest, but it's also a chance for you to kind of manage your investor base. I think that's very, very important, and something that a lot of entrepreneurs do not do at early stage just because they're so eager to bring in money. Next slide.
Fantastic. Thanks, Alaa. So let's talk about the financial issues, and in particular about cash, which is obviously, you know, near and dear to all of our hearts. But we'll also touch upon some other aspects of financial management as well. You know, clearly, managing our cash and managing our cash burn is going to be critical at early stages, right? And I'm sure that, you know, I mean, every entrepreneur I know, when they first get started, they're managing their business to cash, which is the most important thing, and not really worried about things like, you know, income statement and balance sheet items so much, but more about how much are we using, where is that money going towards, and are we using our money wisely? And so obviously, you know, understanding that, I think is probably something that most of us are kind of do by nature. But you know, there's more to it than that, right? There is making sure that, you know, that we are meeting our objectives and our milestones, as Alaa just alluded to in the prior slide. Because obviously, you know, we're going to be building a product or a service that we're hoping to sell a lot of. And so it needs to be robust. It needs to be, you know, as complete as possible. It needs to have the best features and best benefits to our customers. And that obviously takes time, and it takes a lot of money. And so understanding where that money is going towards and spending it wisely is really the critical thing that we can be doing here. And you know, you know, I'll touch upon kind of checks and balances. You know, initially, you know, when we're a really, really early stage company, and it just may be a founder who's doing work on his or her own, or maybe a couple of founders or a couple of partners who are kind of trying to get stuff off the ground, you know, there is no whole lot in the ways of checks and balances, but just making sure that you're keeping an eye on you know, on the numbers, right? You know, making sure that you are checking your checking account on a monthly basis, and making sure that we're spending the money that we think we should be spending and not being caught by surprise is really, really critical. If there's more than one person involved, then obviously getting the buy-in and making sure that everyone is on the same page with regards to where we're spending money is critical. You know, having someone or, you know, or more than one person managing the cash and managing the distribution of information with regards to cash, you know, to other vested parties is obviously very, very important. But really, you know, initially it's going to be about cash management. But, you know, I also want to stress that, you know, while initially we may be really, really focused purely on cash, and so we're kind of running our business by, you know, looking at our checking account balances and our credit card balances, and making sure that everything is getting paid off, but understanding how much we're spending on a weekly or monthly basis is critical. But it's also really important. The earlier you can get started in kind of setting up your infrastructure, your accounting and data collection infrastructure, so that you can be prepared for success not only today but in the future, is really, really critical. And so, while many entrepreneurs kind of initially start and they don't really kind of log anything, they just kind of keep copies of their checking account statements or operating account statements, and that's kind of really all they're doing. They're not doing much more than that. That's really, I think we can do a lot more initially, and for not a whole lot of money, right? So we highly recommend that, as soon as you kind of get started, look into like a QuickBooks Online or a Xero or some other online accounting system where you can at least enter data, have a repository of places where you're going to be able to put copies of invoices. So Dropbox or Google Drive, or Box.com, someplace like that where you can start maintaining records of what's happening, where you're spending money, so that when it comes time to do a little bit more than you're doing today, that it's going to be relatively simple to take that and put it into either QuickBooks or some other place where you're going to be able to keep track of your accounting more diligently than maybe when you first get started. But obviously, since we're an accounting firm, and since both Alaa and I are finance folks, we highly encourage that if you want to do it correctly, that you can save yourself a lot of pain in the future by keeping track of your expenses immediately from day one using something like QuickBooks Online. It's really, really cheap, easy to sign on. It doesn't take anything other than just going onto the Intuit site and signing up for an account and giving them a credit card. The monthly fees are really, really cheap, and that way, not only will you have a system where you can keep the information, but you'll have made a big move initially to make sure that that when the time comes where you need more robust information and more robust reporting. So for example, when you go and try to pitch your idea to outside investors, if you go to a bank to try to take out some money, all of those institutions will require financials, right? And you won't be able to be, if you're not using QuickBooks Online, or if you're not using an accounting system, it'll be really, really difficult for you to prepare the documentation that's required that's going to allow you to raise funds from the outside. So that is an area where we where we are kind of hard over that everyone should be doing this. We know that many entrepreneurs won't. And I can tell you from firsthand experience, and I'm sure that Alaa can too, that we get called in from prospective clients who have their moment where they realize that what they've been doing up until now is not sufficient and they need professional help. And so they call us, and then when we go in to look at the last 6, 12, 18 months of data, that it's going to be a bear, right, to try to figure out kind of what happened over the past 6 to 18 months or however long it's been. And the amount of effort and the amount of cost it actually takes to kind of bring the books up to date is probably greater than it would have been, if we had been kind of doing it all along and kind of at least maintained transactions in an accounting software. So something that we highly, highly recommend initially, at least. And you can just make entries yourself. You could hire a cheap bookkeeper to come in for a few hours every week or every month even, to kind of get everything into the system. And that's all it takes. And if you at least do that, then when the time comes for more robust reporting, it'll be a whole lot easier and you'll save yourself a lot of pain.
All right, so those are excellent points, Sirk, and I think that leads on to our next point is infrastructure, and I think the accounting and finance infrastructure is exactly what Sirk was just talking about. Don't wait till you raise a round or where you have venture investors or outside investors in your company. Getting started early with an accounting and a finance infrastructure is so important. And as Sirk mentioned, it's really not that expensive. QuickBooks, the ubiquitous platform, is very, very cheap. I don't know, anywhere between $30 to $50 a month. And it's so easy to work with. Link it into your bank account early on and start downloading transactions, or hire a bookkeeper. You don't necessarily in the early stages have to go and hire a company like ours, but there are a lot of alternatives. Don't do what most folks do in their personal finances, where you're figuring out your bank balance by every time you go to the ATM machine, or you're logging on to your bank website. So putting in an accounting or a finance infrastructure really is really the first step that you should take once your company starts rolling, and once you have some financial transactions that are happening. Figuring out the right bank to go to is also very key. I think a lot of people that have not maybe ventured into the corporate world, they perceive going to their bank would be the first step to setting up a business account. A lot of times, the big banks, the Wells, the Citi, and Bank of America, they're geared for larger enterprises, and they will not give the same level of services that a new company needs. So looking at the appropriate banking infrastructure early on is key. Also, depending on your type of business, getting the right kind of bank to help you is important. Are you doing a lot of exporting? Are you wiring money abroad, or bringing money in from abroad as part of your business? So certain banks might be better structured in that. So do your homework and get the right banking that will help a great deal as your enterprise grows. The HR infrastructure is really important. When I talk about HR, it's, you obviously will have payroll. So getting in at the very basic, getting in a good payroll service. And one of the things we mention in a lot of our other early enterprise webinars is do not do payroll on your own. There are lots and lots of payroll service providers out there. The Gustos, the QuickBooks has a really good platform. There's literally lots and lots of different payroll providers out there that will do varying levels of service for you for payroll. But one thing that you should never do is file your own payroll taxes. The payroll taxes, while not extremely complicated, they do have a complication factor, but they also have timing and ways to fund it that these companies are really structured to do. The penalties for late filing are significant, and you're not working with your own money. Typically, the payroll taxes that you're withholding from your employees it's a fiduciary responsibility that is very, very critical. So you need to make sure that gets reimbursed to the appropriate taxing authorities. And like I mentioned before, the penalties and fees for minor errors could be fairly significant. The other part of the HR infrastructure that you should think about, especially if you're in a competitive environment, is your benefits. And by benefits, the most common one is health benefits. So there's, again, a lot of different opportunities to go there. You could go direct to insurance brokers who could help you with that. There are companies like TriNet, Sequoia, that will essentially take over the whole HR service infrastructure for you, do your payroll, do your health benefits, provide things like employee handbooks and kind of an HR structure on a per employee fee basis. If you have a very complicated environment and you're hiring a lot of people, maybe it's best for you to start hiring HR professional to help you with all the different areas, compliance and policies and procedures, getting those in place could save you a lot of headache and a lot of legal issues. There's so many companies that I've talked to that have had employees sue for one reason or another, and I will tell you from my experience, and maybe Sirk could chime in, that whenever an employee sues an employer, it seems like the employee always has the upper hand. So getting the infrastructure in place to protect your IP, to have the agreements in place when an employee signs, and to make sure that you're legal 100% is really important. So get somebody to help you with that, whether it's a part-time consultant or one of the EPOs that I mentioned. I think that's very, very important. And finally, a lawyer. You'll find that if you're in business that you, just like an accountant, you need a lawyer. Whether that is a general corporate lawyer or a lawyer that is more specialized in the area that you're working. If you're in real estate, you need real estate lawyers. If you're in, if you're manufacturing a product, get a lawyer that knows that area well. If you're raising money, get a lawyer that has done it before, so they could be your advocate and make sure that you're that you are protected during any kind of investment scenario. Also, a lawyer that could help. We mentioned HR issues. A lawyer that could help in that area should the need arise. IP. If you're filing patents, trademarks. So think about what kind of legal help you will need, and make sure you have a lawyer that could help you and that could give you the service that you want at the price that you can afford. Being here in Silicon Valley, you'll find that a lot of companies kind of go towards the big boys right away, the big law firms. While that might be the best choice because they have a lot of experience, and a lot of times they'll give you pro bono work in the early stages if you're a VC-backed company, you may find that day-to-day transactions get to be a little bit more expensive, and that the attention that you get from the larger law firms may not be what you require. So maybe going to a smaller, more experienced, more nimble legal firm is a better way for you to go. So think about that area as well, but definitely have some kind of legal consultation or somebody that you could turn to at the various stages of your enterprise is very, very important.
Yeah, thanks, Alaa. And I'll just also add just one final thing on the legal infrastructure. So many of our clients, to Alaa's point about general counsel at bigger firms being expensive, we know that. A lot of our clients, what they do is they might use somebody larger to help set up the company. Like I said, they tend to have lots of templates that can be used to get things started. They also have lots of templates and lots of expertise when it comes to fundraising and assisting you with kind of valuations and term sheets and things like that. So it's kind of nice to have somebody like that on the bench. For us to bring in, but then they also use, specialized law firms or lawyers. Maybe someone who does, strictly contractual work, right? So looking at reviewing contracts to make sure that you're not that you're not putting yourself at risk. And a lot of these companies are smaller, more nimbler. They take on more of on an as-needed basis type of effort. They tend to be cheaper on an hourly basis. A lot of these firms are virtual companies, and so they have less cost structures than bigger firms. A lot of them, they have lawyers across the country, who work from home and can provide expertise at reduced rates. And so you might want to look at something like that. If you have IP issues, there might be specific IP attorneys that are that are not only expert in specific areas that you might be interested in, but also maybe a little bit cheaper than kind of these big, all the big corporate firms that tend to charge a lot. So keep those kinds of things in mind. And we can go to the next slide, Patty, and I'll kind of just bridge these two slides together, the infrastructure as well as hiring, to start by saying that, one of the things that, as you probably know, hiring employees is really, really critical, right? It's critical to the success of the company, but it's also probably in most of our clients' experience, it's the most expensive expense, right? Our people expense tends to be the most that we spend on anything. And so, we kind of, we want to be really, really careful. We want to plan our hiring correctly, and then we want to execute our hiring correctly. And even before we kind of get into the nuts and bolts of the actual errors or mistakes that we sometimes see making, one of the things that we really recommend nowadays more so than ever, is that the service, the way that we provide service, has really changed, right? So all about the people who would rather go it alone and do consulting work on their own instead of joining companies full time. That works for both sides, right? That works for the people who are providing the service, but it works great also for companies who need to hire experts. And so, one of the things that we'll try to have you look through is, whether it makes sense to hire people directly as W-2 employees, or whether it makes sense to hire people or specific needs on a contract basis, right? Either as consultants, outsourced services, like for example, lawyers. And obviously you're not hiring lawyers initially. We highly recommend that unless you really, really have a lot of need on the accounting side, that you hire accounting folks, firms like Early Growth or others who provide this service on an as-needed basis, so that you're not sinking your resources into hiring people when you don't know the value that you're going to get. Similar to consulting, right? There's lots of consultants out there who are really, really expert and who give you the flexibility to be able to hire specific people for not necessarily full-time, maybe for projects, or maybe to kind of tide you over, or to develop a certain feature that you need in your product, but you don't really think that you're going to need people to be with your firm for years. So keep that in mind. We're moving more and more toward an outsourced business model across many of the industries that we support. And so we, depending on the kind of company that you're starting up, we certainly highly encourage you to look in that direction as well. So having said all that, when we're ready to hire, obviously, we want to think through, the needs of the company. Every company has different needs at different times. So think about your hiring plan. Think about what that's going to mean to your finances. Think about what that's going to mean towards your product development, your service offerings, sales efforts, all those things. But the main thing for us is really the first two bullet points here, which is you want to hire slowly and you want to fire quickly. And unfortunately, the experience that we see a lot is the exact opposite, right? Where we see companies who need somebody and say, oh, we need to hire a software engineer pronto, and we're not getting work done, and so we need to hire someone. And so they'll go through and they'll try to, go through a few resumes. They'll, interview 2 or 3 folks, find the best person out of those 2 or 3 folks, and then hire them immediately in the hopes that it's going to work out. And sometimes it does, and sometimes it doesn't. And unfortunately, the process of terminating an employee is difficult. And so, and not only is the termination difficult, but it's also, we're obviously putting we're putting a lot of our efforts, right, into training, into hiring, then training, getting them up to speed, before they're really adding a ton of value. And so there's a lot of costs on the front end, right, of getting an employee started. And so we really encourage you to be careful, thoughtful, and just kind of make sure that it's the right thing. And it's not even only from a technical expertise standpoint, but boy, the culture of the company, especially those initial hires, it's really going to be driven by, you know, the personality of the employees. Obviously, the founders will have a big say in that, but you know, when there's only 4 or 5 or 6 employees, every individual hire's personality is gonna shine through, you know, into that company. And so, you know, communication styles, making sure that that makes sense, or make sure that that's a good fit for what you're looking for your organization. You know, obviously, you know, level of expertise, but even just, you know, a good sense from you, and doing your due diligence, you know, checking references, making as sure as possible before you make that hire on the front end is really what we encourage. And then on the back end, you know, and we see this mistake too, where, you know, where an employee is really not working out. Maybe that employee is slower getting up to speed than we were hoping. Maybe they kind of, you know, exaggerated their expertise in a certain specific area that is critical to our success, or maybe the fit just isn't there, right? Maybe, you know, maybe the personality is really grating on other employees, and it's clear that, you know, that there's a problem. Well, you know, we just think that you know, when problems start to arise, you need to nip them in the bud. Right. And so, you know, while we wouldn't encourage you to, you know, at the first sign that there might be issues that you fire anyone, we certainly, you know, encourage you to think about it, make sure that you're documenting things properly, but really to make a decision to let someone go quicker, rather than, you know, let any of the issues really fester within the organization, both from an expertise standpoint as well as a culture fit. And so, you know, please keep that in mind. You know, compensation is obviously a key consideration as you're looking to hire people. You know, we have some equity ranges here for non-founders. If you're in a tech startup that is offering stock options to employees, then, you know, these are some of the ranges that we would see early on. You know, the amount of equity of the company that you would give in terms of stock options for non-founders, but obviously salaries, bonuses, commissions, all those things you need to take into consideration. It's obviously hard for us to give you guidelines because so much is dependent on the industry that you're in, the geographical location that you're in, as well as obviously, you know, differing levels of expertise that you may be paying for. There may be some hires that are really key critical hires where you need someone who not only has expertise but who has the gravitas, right, within your industry. You may have that person be, you know, signaling the direction of your company. You may have that person be kind of a spokesperson, right? They may be a BD/marketing/salesperson that is going to be out there talking to outsiders on behalf of your company. And so, you know, for key hires, obviously you want to give that more consideration. You know, make sure that you're paying not only a fair compensation, but one that makes sense for you as a founder and as a company, to make sure that that we have the resources not only to pay this person, but other hires, you know, that are going to be following on. So all those things, there's tons of places that you can go to get information on compensation studies and equity studies, you know, built out by, you know, different industries and geographical locations. I highly encourage you to seek those out. Have those as references, you know, for you to check on, and also obviously, you know, talk with, you know, business partners as well as other entrepreneurs that you know, who can assist you with, you know, making good decisions in this regard. But hiring mistakes is one of the key things that we see happening that really derail a company initially on, and so, you know, this is one that you need to pay a lot of attention to.
So those are great points, and I think just one thing to add on the hiring, front, use your network. I'm sure that if you're starting a business in a certain segment or a certain industry, you have a network. You have people out there that know folks, and that's probably the best resource for hiring. Are referrals, people that you know and trust. That is, I think, a very important key advice that Sirk gives, because that could really lead you down a rabbit hole very quickly. So the next one is we'll talk about is resource allocation, and what are the common startup kind of issues that are that you need to pay attention to. So, for example, if you need certain resources to provide, product development, or you need the marketing, you need all kinds of resources in a very early stage. So each time that you have kind of a problem that you kind of come up with, you need to figure out what the proper resource that you will. Sometimes the resource is hiring a consultant, hiring a lawyer. Sometimes the solution to that is finding a good employee to kind of cover that business development or that marketing area. In financing, if you need to raise money for your enterprise, you want to be able to do that financing and show that you are in a most professional way that you can. So if you don't have prior experience, if you haven't done that before, find a good lawyer to help you make sure that you have the structure properly. Talk to financial advisors to make sure that you're presenting yourself well, and that that you're going through that fundraising process in the most professional, best way that you can, that protects you and your enterprise. So some of the things will require kind of personal attention. Your contracts that might be provided, and you need some good contacts in that space. So know when you need to kind of pay attention to certain things as opposed to outsource other items. And I find that early on that the entrepreneur probably knows best the industry, and like contracts and negotiations are probably done best by you as the entrepreneur. So just know that how to allocate your resources during the various areas, when to pay attention to something on your own, when to outsource it, and when to hire. I think that is kind of a fundamental advice that we give to entrepreneurs at early stages in the enterprise. Really what makes between the successful entrepreneur is then maybe not somebody without that much success is the navigation of these resource issues that might come up, and how best you address those. So just kind of pay attention to the areas, do a self-assessment, know where your strengths are and where your weaknesses are, and when there's where there are weaknesses, know that there's always help and other resources that you could fall back to.
Great, thanks, Alaa. So this is our last slide here. It's just a quote from the Lean Startup, which is a book that we highly recommend that all entrepreneurs or would-be entrepreneurs would read, and it really stresses. Well, this quote kind of stresses the main point. But what you're gonna find is this: that what you want to do is you want to plan. You want to put the best plan, to the best of your knowledge, at at this point in time, you know, and put it together and drive towards that plan, right, and manage that plan. However, you're going to find that you're gonna you know that things are going to change, right? You know, we talk about pivoting, right? Most of our client companies pivot, you know, many times, you know, once, twice, many times. Maybe the market, you know, it doesn't move the way that they were expecting. Maybe it takes longer to build the product than we thought it was going to take. You know, maybe as we're kind of, you know, developing the product, we find other you know, tangent markets that are more suited, right, for where we're going. And so we make these, or maybe our distribution channel strategy changes. So there's going to be changes along the way. One of the best things about being an entrepreneur and a small company is that we're nimble, right? We're able to see things happening and quickly make changes and pivot along the way to, you know, put us in the direction of being successful long term. And that's one advantage that a small company has over a big company that it really just is not able to do that, right? A rowboat versus versus a ship liner. And so take advantage of that, right? But in order to really do that, you have to have a plan in place. You have to be driving towards a plan and be willing and able to make changes along the way. But obviously, if we just kind of get started and just kind of assume that things are going to work properly and assume we're going to start making money and assume that the product development is going to be relatively simple and straightforward and not take much time, then we're really not putting ourselves in the best position to be successful long term, because I guarantee you that there are going to be challenges along the way. Things are not going to go exactly the way that we planned, and we're going to need to make pivots. But in order to do that, we obviously have to have a plan of record, and we need to know the direction that we're going, so that as things change, as the assumptions change, then we can make changes along the way. You know, we'll just kind of leave it at that. Leave a few minutes for any questions that Patty might see. But you know, before we even get to that, I just want to just encourage all of you guys, you know, who are either doing this or thinking about doing this, you know, that we wish you the best of luck and best of success, and hopefully you'll be one of those that are out there changing this world.
At the moment, we don't have any questions. I will be sending the recording and the slides later today or tomorrow, and I will copy both of you. So if any of you have any questions, you can ask them directly to our panelists through email. Any final thoughts?
Thank you very much.
Thank you all. Really appreciate your time.
We have two more questions. Do you mind?
Okay.
The first one is, if a person is at will employee, does that mean you can fire them?
It does, yeah. California is an at-will employment state, as well as a lot of other states, which basically technically means that you can fire them at will, and that they can also leave at will, right? So that's kind of what at-will means. But having said that, that's the technical definition. Having said that, it also you know, there's also nothing stopping from an employee who's been fired or terminated to sue us, right? And so so this is where we recommend strongly that you document things. You know, if it's really early on and you're just kind of getting to learn each other and it's just not working out, that's one thing. But if if an employee has been with you for a year, 18 months or whatever, and we're thinking about terminating them, then we want to be documenting the reasons why, right? It may just be a simple matter of, hey, we don't have the money, we need to cut expenses, and unfortunately you need to be let go. It may be it may be something other than that. If it's something other than that, such as, you know, you're not happy with their behavior, or they're really not doing what we expect them to do, or they're not being successful. We want to document that so that if it turns out that the employee, the terminated employee, is disgruntled and decides to sue us, that we have documentation to support our decision, even though technically we are an at-will state.
Yeah, those are excellent points, Sirk. And at will doesn't necessarily mean, doesn't protect you against wrongful termination claims. So, you have to be careful on that as well. An at will employee can't be improperly terminated for various reasons, whether it's, uh, you know, uh, personality based or some other issues that may lead to wrongful termination claims. So be careful. And I think early on, Sirk mentioned that when you do hire, make sure that it's the right hire, just because these kind of issues come up. It's not just a situation where you could just say, I'm going to hire somebody and then just terminate them whenever I feel like it. You know, even though we're an at-will state here in California, terminating somebody is involved, and you need to do it properly.
Mm-hmm.
Perfect. One last question. What do you recommend for cash compensation for a CTO?
Sirk?
Well, again, I'll just kind of reiterate that it's just hard, right? We need a lot more information. So, you pay a CTO here in the Bay Area or in San Francisco a little bit differently than you would pay, the same person in Denver or Austin, for example. It also depends on, the stage of the company that you're at. Are you just getting started, or have you already raised a Series A or a Series B? The later you go, you'll probably end up, giving a little bit more salary, because you've got the resources to be able to offer a little bit more salary and a little bit less equity. Initially, you may offer a lot more in terms of equity, to get someone to come into the door when we don't have the cash to be able to pay a higher salary. So it just kind of depends. There isn't really a set answer. Out here in the Bay Area for early stage companies, meaning, Series A, funded companies, maybe Series B funded companies, what we tend to see is, somewhere in the range of $180,000 to $200,000 in salary, plus, like we said, several percentage, several percent of equity of the company. That's kind of a starting point, to get started. I would say a lot of VPs and C-level folks at startups here are getting paid, call it 180, $15,000 a month
Sure.
is kind of a starting point.
This will be for a very, very early pre-seed company.
Yeah, in that case, I think what you're going to want to do is you're going to want to, structure something like, hey, listen, we don't have the money to pay you a ton of money right now. This is what we can offer you from a salary perspective. We're going to make it up for you on in terms of equity, and we will revisit your salary, as we raise another round of financing, or as because I guarantee your investors, if you get institutional investors, VCs, the VCs want employees to be paid a fair salary, right? They don't want people to be disgruntled. They don't want people leaving because they're not fairly compensated, when in fact, obviously, the key to the success of our company is going to be on the contributions of our key employees. So it's not like we're going to be kind of, paying a small salary forever. But immediately when you're first self-funding, you just don't have a lot of money, right? So a lot of it is going to be based upon, hey, look, I'm a founder, I'm getting almost nothing, I'm taking down nothing. I'm hiring you to assist with this company. We're going to be successful. You're going to reap the benefits of that success more in terms of the equity valuation as opposed to annual salary. And so hopefully you'll be able to negotiate something where you're offering a smaller salary initially, with more equity, and then over time, as you get more money in the door, you'll be able to increase their salary, to be more commensurate with competitors.
So I'm sorry to be glib on and I don't mean for this to be a trivial question. I think is probably the number one question we get from most entrepreneurs is, what should I pay and what kind of equity compensation that I should give. The problem is that it's very, very it varies, even for seed stage, early stage companies. And the answer I typically give is, what can you afford and what is the negotiation of the person that you want to bring leading to. So don't let salary, I mean, of course you have to pay what you could afford, but don't let the salary be the sole judgment of who you hire. For example, there's two candidates, they're maybe $50,000 apart in compensation, but the $50,000 more expensive person could really change your business. They could bring in a certain skill set. They could bring in a certain industry knowledge. They can do something for your company that is critical. That it might be worth that extra $50,000. So the answer is that you need to kind of go into the market and use your pay what the market is bearing, but also use your judgment in making that hiring evaluation, and don't be kind of penny wise and dollar foolish, because a lot of times the more talent that you have and the somebody who's demanding more might be a better fit, might be somebody that could really change your enterprise, might be, if it's somebody in the sales area, might have contacts that could get you to close deals a lot quicker, or get you into businesses that you may not be able to get to on your own. So don't kind of look at as salaries, especially in your key players, your VPs, your CTOs, your head of marketing. Get the right mix and make sure that you compensate them accordingly. And of course, you have to manage your budget accordingly. But I find that if your business is exciting, and that's what makes Silicon Valley, you're able to attract talent without a lot of money, just on the promise of your business. And you know, it's a negotiation, but think it through. And I think probably the most critical decisions that you make as an entrepreneur or head of a new business is the hiring decisions, especially with your key players.
Yep, agreed.
I'm gonna cut it here. We've passed the time, but if anyone has questions, please send it through email. Thank you so much, Sirk and Alaa.
Thank you all.
Thank you all.
Bye.